This is Matthew Kratter's Bitcoin University. Today I want to talk about the best Bitcoin monthly income strategy, and this is a follow-up to yesterday's video about how to get Rekt by MSTY. There was a good question that a number of people had. Are there any good options for someone who's looking to increase their monthly income through a dividend stock like MSTY? I save in Bitcoin and BTC, but could use more fiat income for monthly expenses as a sole provider. Here's my answer, my dear fellow fiat refugees. You no longer need a dividend stock or bond or money market or investment property in order to get monthly income. Now, Wall Street and influencers who may be on Wall Street's payroll want to sell you Bitcoin yield-like products. There's this guy, for example, who's done a lot to spread awareness of MSTY. He really seems to like it. And then he is almost certainly being paid by YieldMax, who puts out this product. So you have to understand how these things work in real life. Wall Street wants to sell you Bitcoin products when in fact the solution is so easy. You just buy BTC and hodl it. That gets you censorship resistant money that cannot be debased by any central bank. It also gets you really high returns without having to take on any counterparty or operational risk of the kind that comes from investing in Bitcoin treasury companies or ETFs based on them. So what about monthly income? It's really quite simple. You just sell off small pieces of your BTC as needed. Hopefully you're not doing this to quote unquote take profits, because Bitcoin itself is the exit. Hopefully you're not doing this to take profits or to buy some depreciated asset like a Lambo, but of course it is your money, so you can do what you want with it. But living off your BTC is sort of what it means to be living on a Bitcoin standard. People say they don't want to sell or spend their BTC, but to the extent the more and more you hold that, the more and more you're going to actually have to live off of it. And we're all trying to aim for this goal of helping to jumpstart and bootstrap a circular Bitcoin economy where you try to earn Bitcoin and spend Bitcoin, so you don't sell your Bitcoin for fiat to spend it. Instead you just spend the Bitcoin directly, and you don't buy Bitcoin. Instead you earn Bitcoin. That's at least the ideal. But if you have Bitcoin, you can also, or if you have extra savings, you can also store those savings in Bitcoin and tap them as necessary, converting a small bit to fiat for monthly expenses as necessary. I'll just pause really briefly here to say, if you're finding this video interesting, helpful so far, please help to support this channel's educational mission. Hit the subscribe button. That does really help. Leave a like, leave a comment, question, suggestion for a future video, and share this video with a friend or family member. So I wanted to give a concrete example of this. Let's say, just to make the numbers really round and easy to work with, let's say that you have $1 million that you want to invest and that you would like to generate $50,000 worth of annual income off of that investment. And you have two choices. Choice number one, put the whole $1 million into BTC and then sell off a chunk every year for income, or really every month, but we're going to just do the annual calculation, make it easy. So you can either put it all into Bitcoin. Choice number two, buy an income property or bond that generates a 10% annual net return. And that's a pretty insanely generous unlevered net return for real estate or bonds. So I think I'm being generous there. You can buy an income property or bond and then put the rest into BTC. So I built a quick spreadsheet here that shows this. Choice number one, you start with $1 million. We're going to assume 40% annual returns for Bitcoin over the long term. And so this next column is just your annual return, 40%. That's the total after your annual return. And then you're going to be selling off $62,500 worth of Bitcoin every year. And that's using the 20% cap gains tax, which applies to most people in the US, I would guess. And then that ends up with 50,000 net to you for the year. So this is years 1 through 10. Here's the ending value, gets taken over here. And basically you're paying yourself $50,000 worth of Bitcoin every year after tax. So that's choice number one we were talking about. Choice number two is you put this into an income generating property. This could be a bond. Here I'm going to just pretend it's an investment property. You buy a rental house for $625,000 at a 10% net rental yield, which is being very generous in this environment. But let's say you can pull out cash on cash 10%. You can do the leverage calculation if you want, but we're not levering up our Bitcoin purchase, so I'm trying to do everything in an unlevered basis. Obviously real estate's more often levered, but let's just say you pay cash for it. It has a 10% cash on cash net annual return from the rental income minus property taxes, etc. That gives you $62,500. We're just going to assume that the tax rate is the same for this. Now, normally, normal income tax rates are higher than the capital gains tax rate that you would be paying on your Bitcoin if you had held it for more than a year. We'll just use the same tax rate, but you can adjust this, and that gives you $50,000 a year after taxes on this property. You spend $625,000 on this investment property. That leaves you $375,000 left over in year one to buy Bitcoin. So this house is going to be generating $50,000 a year for you. It'll obviously ratchet up over time, as will all of your costs, etc. But let's say you put the rest in the Bitcoin, $375,000. At the end of 10 years, that $375,000 compounded 40% annually will be about 10.8 million. But if you had put the entire amount into Bitcoin instead, and even if you'd sold off a little bit, as people are so loath to do, if you'd sold off a little bit to create annual or monthly income, you would have been paying yourself $50,000 a year, and instead you would be ending up with $24.5 million worth of Bitcoin rather than just $10.8 million worth of Bitcoin. Again, you may dispute some of these numbers. You're welcome to build your own spreadsheet. I'd be happy to share this spreadsheet as well if people want that. But you can do your own calculation of returns and see what works best for you. You may want to adjust the tax rate on that monthly income, because obviously if your income's between $23,000 and call it $97,000 as a married couple, that's going to be taxed at 12% marginal rate. Of course, your capital gains tax may be lower in that tax bracket as well. It might not be quite 20%. It may be something like 15%. So you can play around with the numbers. Other considerations, obviously, there's the path dependency of Bitcoin's price. It never goes straight up at a steady 40% per year. What you usually get is just pumps and dumps and stuff. But if you are selling every month, for example, this should sort of smooth itself out. Another consideration, you can apply depreciation, of course, to rental income from an investment property. But houses, of course, do come with real maintenance costs. They do depreciate. So this is a little bit of a way of deferring your taxes on rental income. But you are going to have to pay for that maintenance and that wear and tear at some point. Rentals also come, as we alluded to earlier, they also come with property taxes, insurance, occupancy rate risk, tenant risk, all these other risks. And Bitcoin lets you avoid all of these and sleep soundly at night. If you put your money into a 10% yielding bond, it's a fairly high yielding bond, and so you'd have other worries as well. There wouldn't be no counterparty risk and no operational risk. So Bitcoin, unlike all these other things, really lets you avoid these problems and sleep soundly at night. Your Bitcoin, unlike an investment property, is never going to burn down or get destroyed by a tenant or a tornado or a flood. Lastly, I wanted to answer a couple questions or highlight a couple comments from yesterday's video. Viral Shedding Zombie 5324 had an interesting question. Can the MSTY fund simply stop selling covered calls to capture upside? In other words, try to give people more exposure to MSTR's upside? My answer, no, because their investment mandate is to sell covered calls. That's the main thing they're supposed to be doing. If they stopped doing that, they would just be charging you 0.99% to hold MSTR, which you can do for yourself for free. So we never really see this sort of investment strategy drift. It's not what ETFs do. And Ortodontia Costa Rica 4184 writes in totally wrong. MSTY uses synthetic covered calls, as if that would make a difference. My response, options payoff diagram is exactly the same for synthetic covered calls. That's what I was talking about with the long equity swap on the long side, or you could do a long call spread, or you could make the long part of the position a long call, even a leap, and then a short put. So there are many ways of doing it, but the payoff doesn't really change. It may be a little bit more highly levered, but whether they're using synthetic longs or regular longs, buying MSTR or doing a long equity swap, shouldn't make any difference for the returns. Then I want to highlight these are the returns for MSTY. And if we take a look at the 1 year return and then compare it to MSTR, 1 year return for MSTR 183.86%, 1 year return for MSTY 133%, year-to-date return for MSTR 55.84%, year-to-date return for MSTY 45.82%. This is what I was arguing yesterday, that however you do the accounting of return of capital, what you're really doing is you're giving away the upside. This is what covered calls do. They make sense if something's going to stay sideways and volatile, and you can sort of monetize the high volatility, the high implied volatility. But what we're seeing in fact here is what we would expect theoretically and from first principles, is that MSTY would underperform MSTR on every single time frame. And that leads us actually to this comment. Indian hodls saying, Matt, what if someone has $10 million to put into MSTR, but they put $9 million into that and $1 million into MSTY, and they can live their life very comfortably off the dividends from that 10% MSTY allocation and never have to sell MSTR. Is that bad? You say to sell your BTC or MSTR as you go. This is akin to that. It is simply selling a max 10% to potentially never sell any more MSTR if the strategy works. And by the way, the BTC stack behind all this is completely untouchable. Is that not at all compelling? So in response to basically this idea that MSTY will always underperform MSTR, which seems reasonable to me from first principles, and that's what in fact has happened, because when you sell a call against a position, you are literally giving away the upside in exchange for collecting that premium. So my response to Indian hodl here, it's more optimal to put your cash into the asset that you think will have the highest compound annual growth rate, the highest CAGR, and then sell off little bits to generate income as needed. MSTY will have a lower CAGR than MSTR, so why waste money on it? So if you had the $10 million and you really liked MSTR, personally, I would just put it into Bitcoin. But if you wanted to pursue the strategy, you'll have much higher returns and much less risk putting it into MSTR. Finally, BTC here, BTC to the infinity in the OC, something like that. He or she writes, MSTY is an income fund. Why is it so hard for people to grasp this? My response, quote unquote, income fund is just a Wall Street marketing category. There's nothing special about that. There's nothing more fiat than it. Why is this so hard for Bitcoiners to grasp? Lastly, I wanted to leave all of you, there were some questions about what is it, MSTX and some of the other levered MSTR products. These are extremely dangerous to hold for more than a day because of how the compounding works. So as a reminder of that, I just wanted to drop this in the description notes below. If you're holding any of those for an extended period of time, you're going to be subject to a lot of returns drag. You're not really going to get the full levered return. So be sure to watch that to be aware of the risks that come with not just MSTR leveraged ETFs, but all leveraged ETFs like the S&P 2x or the QQQ's 3x. These all have that same problem. And so if you really want to trade those with leverage, you're much better off doing it with futures. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.